Hi, welcome to the Bullish Bears YouTube channel. I'm Jeremy, and I'm setting up a series of advanced charting techniques made easy. This is video number 3, but technically I'm going to fast forward a little bit, and then I'll go back to some other stuff in the past as well. But this is something that I think is important now, and you're going to start seeing a lot more of this in the market, I think, starting this year. With a new administration in office, this is kind of going to be a par for the course type of thing. So I thought I'd bring it out now. So what I want to show you is how to identify a false breakout or what's otherwise known as a liquidity trap. And these happen on every time frame, right down to a 5-second chart. You can do this. This is just a simple technique on how to identify them, particularly in a bull flag, but it can occur in any accumulation, whether it's a channel, a descending channel, rising wedge. All of those patterns have the same commonality of the ability to pick up a liquidity trap and spot exactly where you should be looking for it. So let's start with the general shape here. We have a nice clean bull flag on Google. This is real time. Well, market's not open today. It's Saturday, but yeah, you get the idea. So we're looking at a nice clean bull flag with compressing range, and it had a breakout. Well, that wasn't the first time. We had a breakout here, we had a breakout here, we've had a breakout here, a test of support, failed breakout, test of support, so on and so forth. How do I get this information? All you really need to do is start with the second impulse in the pattern. And we have the primary here. This is defining the widest part of this compressing range. We have the high and the low. And by that time, you see a second impulse off of that low that comes back to about half of that range. And then a break where it goes up to about where the 86.6 fib level would be of the previous high, roughly, excluding this wick. Not so important. What's important is we caught a rebound here, and we were able to size it. By this time, we would have drawn an angular trend line across these two highs instead of having it out here. This can be adjusted later. You can adjust the range of your drawings. Be flexible with your drawings. The most important part of this video, and I'm going to show you here, is this second impulse. Use that as a gauge. Once you've established a high and a low and a regression line within that channel, whether it's a wedge, broadening pattern, doesn't matter. Any channel where you see consolidation in any direction, sideways, up, down, doesn't matter. Second impulse, measure it for size with a simple box drawing tool. At that point, anytime you see a breakout above angular resistance or below angular support, drag that box over. So here we had an attempt. We established our trend line up here at this point, and if you drew it in a continuation with a ray, it continued well beyond a point, and the first liquidity trap is laid. So you see this impulse here. This looks like a three-wave bull flag. A lot of people get suckered into chasing this higher, and here's your liquidity trap. That wick right there was full of limit orders from mostly institutional blocks of trades going across the tape, selling at whatever limit order they had. And it looks like retail chased it and nailed everything in that ladder of limit orders. And it only hit about the halfway point of the second impulse to regression range. So once it rejected here, don't fall for that trap. Don't go chasing this breakout higher. Wait patiently. Or if you want to day trade it or overnight swing it, it could go bearish here. Okay. Second indication came down here. We had a little break. We've already established our angular down here. I included the wick on this one at this point, in spite of excluding these wicks. Doesn't matter. At this point, we saw that this was a failed attempt to break out as well. And that leads us to where we are now. I've duplicated this box, and I've drawn it over here. where we are currently attempting to break out. And you can see if we zoom in, that wick went almost exactly to the top of that expected move and failed. It sold right off immediately. In fact, you could have caught a nice day trade, measured move trade right off of this second rejection and rode it for the full width of that wick to the downside. And again and again and again. Now we're starting to see some momentum have a possibility of breaking out, but we know that we're not going to trust it till things get above about 204 here. So we can trade an impulse for day trades, fine by me, but I'm not going to have confidence in this bull flag breaking out until it gets out of this level. So essentially you've just identified a false breakout. If you look left, this is the primary move we're looking to reciprocate above resistance. This is a consolidation kind of split down the middle between the two impulse expectations of move, and this is our liquidity trap. Later on, our targets are still valid. We still have a setup for a measured move on this breakout. We just don't want to jump the gun and get caught in this liquidity trap and getting stopped out of our move when we know where angular support is anyway. That's where we'd rather be in. Can we day trade this? Sure. If we were thinking this was going to be a breakout and we started seeing this, we could still trigger our own stop loss for a win rather than taking a loss on it. So you've prevented loss on the trade, you've taken a small profit, and you didn't get caught in a trap. So I nicknamed this the Trap Detector, and every time frame has it. It's been on monthlies, weeklies, dailies, all the way down to a 5-second chart. I even see them on a 1-second chart sometimes when I'm scalping some really fun stuff in futures. Long story short, it gives you an easy button look at what to expect for the liquidity trap. Secondly, we still have some pretty lofty targets up here. So we could take some consolidating profits off of these and compound our entry for our secondary move even more effectively. And we have 210 and 225 on the outside of this. Thanks for joining me. We'll catch you in the next video.